Hello and welcome. Before we start, please subscribe to our YouTube channel for news and updates. Mega cap stocks led last week, with the growth factor and Nasdaq index outperforming the S&P 500 while the equal weight S&P 500 underperformed. International equities outperformed US equities with developed and emerging markets outperforming the S&P 500 by nearly plus 2% as the US dollar weakened. Bonds traded higher as Treasury yields rallied after a weak July jobs report, with the front end of the curve falling the most. Long duration Treasury bonds and corporate investment grades outperformed as yields fell, while corporate high yield credit spreads widened due to concerns of slowing economic growth. Commodities were mixed, with crude falling sharply on growth concerns, while gold traded higher. Volatility expectations rose, with the VIX rising to mid June levels before retreating. Key takeaways: 1. The first half of 2025 saw a sharp economic whiplash, with GDP swinging from 0.5% in Q1 to plus 3.0% in Q2. Most of the reversal came from temporary trade and inventory distortions linked to tariffs. In Q1, a wave of imports weighed on growth as businesses front-loaded purchases ahead of tariffs. Imports then slowed in Q2, artificially boosting GDP as the trade deficit narrowed. Inventory trends also flipped. Stockpiling added to Q1 growth, but inventory drawdowns weighed on growth in Q2. Beneath these swings, core economic activity weakened. Real final sales to private domestic purchasers, which exclude volatile categories such as imports, government spending, and inventories, slowed to plus 1.2% in Q2 from plus 1.9% in Q1, the lowest since early 2023. Implication: headline economic growth rebounded, but core economic activity has slowed compared to 2024. 2. The July jobs report revealed a slowdown in the labor market. Payrolls rose plus under 73,000, and prior estimates for May and June were revised down by 258,000, dragging the three-month average down to plus 35,000. Nearly all of July's gains came from healthcare and social assistance, while other major private industries and the federal government were flat or negative. The unemployment rate rose to 4.2%, and the number of long-term unemployed, 27 weeks, rose to 1.8 million, the highest since Q4 2021. Implication: the data shows a labor market near stall speed, giving the Fed room to cut as early as September if the trend holds. 3. June's personal consumption expenditures report showed a modest spending rebound after declines in April and May. However, it also highlighted a broader spending slowdown. Nominal PCE rose plus 0.3% but real PCE, which is adjusted for inflation, rose only plus 0.1%, signaling softer underlying demand. On a quarterly basis, real PCE rose at a plus 1.4% annualized pace in Q2, roughly half the average in 2024. Implication: together with softer real final sales and slower job growth, the data indicates the U.S. expansion is gradually losing steam. 4. Our U.S. business cycle indicator, USBCY, began signaling a slowdown in late May when it fell into contraction. The slowdown coincided with a rising policy uncertainty and broader macro volatility. The question is, what happens next? Economic data strengthened as Q2 progressed and trade uncertainty eased, with consumer spending and manufacturing rebounding in June, 7/18/2025 weekly note. Next week will provide another round of data that will show if the June rebound carried over to July. Implication: unless domestic demand strengthens, the economy appears set to downshift in 2H 2025. 5. Magnificent 7 earnings delivered a clear message. Demand for AI infrastructure is still growing. Cloud growth accelerated, and tech giants such as Microsoft, Amazon, Alphabet, and Meta are responding with increased CapEx budgets. NVIDIA, which reports on August 27th, will likely show hardware supply remains a key bottleneck. As long as AI firms keep investing, the CapEx cycle should continue to support demand for semiconductors, power infrastructure, and data center construction. Implication: AI is becoming a macro driver, not just a tech trend. However, with tech CapEx so large, any stumble could quickly ripple through a concentrated market trading at high valuations. It's important to balance the upside with high expectations. Stay calm, stay invested, and let us know if we can help. Visit MRAadvisory.com to learn more and schedule a conversation with one of our advisors. Thank you for listening. For additional information, please visit our website